Everyone thinks money is neutral, that a dollar is just a piece of code, a note, a number on a screen. But that's the illusion, the prettiest one the modern empire ever built. Because every time the technology of money changes, power changes hands. When the world moved from gold to paper, kings lost power to bankers. Now, as we move from paper to digital, the last layer of privacy, the freedom to spend without being watched, is being erased. Quietly. Systematically. The official story is clean and noble. Central Bank Digital Currencies, or CBDCs, are supposed to make transactions faster, fight fraud, and bring financial inclusion. They say it's for convenience, like the card in your pocket, but smarter. But look closer. That same convenience is a perfect surveillance net. The same inclusion is a gate, one that can lock from the inside. Every empire has had its currency of control. The Romans had stamped coins that told you whose face ruled you. The French revolutionaries printed assignats, people's money, that collapsed into paper dust. The British Empire forced colonies to use the pound, draining gold and labor outward. And now, the digital dollar is the same pattern, control wrapped in progress. The paradox is that CBDCs aren't about the dollar at all. They're about data, the new gold. A programmable currency can track every purchase, predict every need, and punish every disobedience. You won't own your balance, you'll merely be allowed to use it. The system can expire your money, freeze it, redirect it, or simply switch you off. In the 20th century, banks could only see your transactions. In the 21st, central banks will be able to decide them. When money becomes code, law becomes algorithm. And the algorithm never forgets, never forgives, and never needs a warrant. So when you hear that the Federal Reserve is studying a digital dollar, or that China's e-yuan is modernizing payments, remember, no empire ever built a new currency without a new cage hidden inside it. Because the question isn't how digital money will work, it's who will it work for. If this opened another side of history for you, comment where you're watching from. To understand the digital dollar, we have to go back, not to Silicon Valley, but to Bretton Woods, 1944. The war was ending, Europe lay in ruins, and the United States held 2/3 of the world's gold. That's when the rules of money were rewritten. The dollar became the axis of global trade, as good as gold, backed by Fort Knox and the trust of nations. But trust has a strange expiration date. By 1971, when Nixon closed the gold window, the promise was broken. Money stopped being metal. It became belief. Since then, every reform of the system has had one goal: to keep belief alive while control tightens. First came the digital ledgers of the 1980s, when banks replaced paper with magnetic tape. Then came SWIFT, Visa, MasterCard. Private empires built not on coins, but on permission. Every payment had to pass through a gatekeeper. Then, in the 2000s, came online banking and mobile apps. The screens changed. The system didn't. You were no longer carrying dollars. You were carrying an access right to digits sitting somewhere in a central database. Now imagine the next step. The state decides to erase the last layer of separation, the bank. Instead of private banks managing your account, the central bank itself becomes your wallet. No middlemen, no cash, no escape. That's the heart of a CBDC, or Central Bank Digital Currency. It's not cryptocurrency, it's the anti-crypto. Instead of freedom through math, it's obedience through code. China was first to build it at scale. In 2014, the People's Bank of China quietly launched a research group on digital currency. By 2020, the e-CNY, the digital yuan, was already being tested in major cities. It looked harmless: pay with your phone, get your change in seconds. But the code had something cash never had: memory. Every coin was traceable, programmable, and reversible. Spend it where you shouldn't, and it simply wouldn't move. Western central banks took notes. The European Central Bank began studies for the digital euro. The Bank of England drafted papers. In Washington, the Federal Reserve called it a future option. But notice the words they used: option, pilot, research. When a government says pilot, it means prototype of control. When it says future, it means already planned. Behind these words are institutions: the BIS, Bank for International Settlements, in Basel, the IMF, and the G20. The same clubs that once coordinated the gold standard, then the dollar standard. Now they coordinate the data standard. In 2021, the BIS proudly announced Project Helvetia, testing how central banks could settle transactions directly on digital ledgers without commercial banks. It sounds technical, but it's revolutionary. The middle layer of finance, the private banking system, becomes unnecessary. And when you remove intermediaries, you also remove anonymity. CBDCs are built on something called programmable money. It means a coin isn't just a number, it's a contract. The issuer can decide where, when, and how it can be used. They can code in negative interest rates. Your money decays if you don't spend it. They can limit use by geography. Your digital dollar stops working outside your city. They can control access. You can't buy more than your carbon allowance permits. The line between monetary policy and behavioral policy disappears. And this isn't science fiction. In 2022, the Bank of England openly discussed programmable features for targeted stimulus. The ECB talked about transaction limits for privacy and compliance. Even the U.S. Treasury, in its 2023 report, mentioned configurable parameters. That's bureaucratic code for, we can turn your wallet on and off. What makes CBDCs truly different isn't just who issues the money, but what they can do with it. In the old system, inflation was taxation through numbers. Governments printed money, your savings lost value. In the new system, taxation happens through code. A few lines can drain your balance, redirect your funds, or prevent a payment. Instead of a tax collector, you'll have a script. Look back in history and you'll see the same pattern. Control first, justification later. When Britain imposed the Hutt tax in its African colonies, it wasn't to collect revenue. It was to force native populations into the cash economy so they'd have to work for wages and pay the empire back. When the Soviet Union issued ration cards in the 1930s, it wasn't about fairness. It was about tracking who obeyed and who didn't. Now, in the digital century, rationing returns, just cleaner, faster, invisible. Money has always been a mirror of power. And every time the mirror changes material, from metal to paper, from paper to data, the reflection shifts from the people to the rulers. The CBDC is simply the latest mirror, polished with the language of progress. Arithmetic cannot be deceived. The moment money becomes pure code, privacy becomes pure illusion. If this helped you see the machinery behind the headlines, comment the word awake. Every system begins with a promise. The promise of the CBDC era was efficiency, faster transactions, safer transfers, less fraud. The language of progress was irresistible, sleek, technical, apolitical. But history has a rhythm. Every new currency starts as liberation and ends as leverage. When the first pilot programs launched, China's e-CNY, Nigeria's e-Naira, the Bahamas' sand dollar, and the ECB's tests of a digital euro, they all spoke the same language: inclusion, modernization, trust. But trust is a strange thing. You can't digitize it. You can only simulate it until the screen flickers. At first, everything seemed to work beautifully. Small businesses used QR codes instead of tills. Governments proudly reported instant transfers of relief payments. The public saw a simple app, not a central ledger humming quietly in the background. It felt like a new golden age of money, clean, efficient, incorruptible. People said, finally, technology is fixing finance. But every illusion needs numbers to sustain it. In the 19th century, the illusion was that gold could back infinite trade. In the 20th, that credit could replace gold. In the 21st, the illusion is that data can replace trust. For a while it works because progress creates its own halo. When everyone's wallet glows on a smartphone screen, no one asks who holds the switch. Governments began to find it convenient. Too convenient. Stimulus packages could now be targeted. In the United States, test runs of the FedNow infrastructure proved that money could reach millions instantly, but also, theoretically, be withdrawn just as instantly. In Europe, the digital euro framework introduced the concept of tiered privacy, small transactions untraceable, large ones fully monitored. They called it a balance between freedom and security. It sounded reasonable, like every compromise before a collapse. And banks loved it. For the first time, they could integrate seamlessly with the central ledger. Fraud detection? Automated. Compliance? Built into the code. Every audit trail led straight to the issuer. To investors, it looked like utopia. To citizens, it looked like progress. To the system, it was consolidation. Then came the second illusion, the illusion of choice. Officials insisted that CBDCs were optional, voluntary. You'll still have cash, they said. But cash withdrawals quietly shrank. ATMs disappeared. Stores stopped accepting bills claiming hygiene or efficiency. The pandemic accelerated it. Contactless became cashless. What was sold as convenience became dependency. You didn't need to ban cash, just make it irrelevant. Meanwhile, every transaction generated metadata: time, location, pattern, purpose. The same way social networks trained algorithms on your clicks, central banks began training financial models on your spending. Not for ads, for policy. If people in one district saved too much, rates could be adjusted automatically. If consumption fell, digital coupons could expire to force spending. Behavioral economics, once a theory, became code. It was the perfect illusion. The state appeared benevolent, the banks efficient, the public empowered. But all three depended on one unspoken assumption: that the issuer would never abuse its control. And that's where history whispers again. The French revolutionary government said the same in 1790 when it issued e-CNY, promising temporary paper backed by confiscated land. It worked until the printing press became addiction. Inflation turned to collapse. Control turned to chaos. Now, instead of presses, we have servers. Instead of ink, algorithms. The addiction is the same, not to money, but to management. Every empire eventually convinces itself it can calculate morality, program fairness, and stabilize chaos. But arithmetic has no empathy. As CBDCs spread, governments found a new power: programmable compliance. Instead of prosecuting crime, they could preempt it. A protest group's donations could be flagged. A journalist's income could be delayed. A dissident's wallet could malfunction. No courts, no headlines, just quiet precision. That's when people realized the cage wasn't coming. It was already built, disguised as convenience. But still the illusion held, because when you can buy coffee, order groceries, and pay rent in seconds, freedom feels like friction. People trade liberty for speed as long as the screen stays green. The same way the British Empire once sold law and order to colonies while draining their resources, the modern digital empire sells efficiency while draining autonomy. Look around today, 2025. Most of the infrastructure is already here: QR-based payment systems, digital IDs, biometric verification. The final step is only political. The moment a crisis requires instant state payouts, and the public accepts direct wallets for security. Once that switch flips, money will no longer be yours. It will be a subscription to the system. And the paradox will repeat itself. The more the system grows, the less freedom survives inside it. The same growth that promised to democratize finance will homogenize it. Diversity of money, cash, crypto, barter, will shrink to a single source code, and whoever writes it will rule not just economies, but behavior. Every illusion in finance has a moment when belief outweighs arithmetic. The CBDC era is no different, except this time the illusion isn't in paper or credit, it's in trust itself. If this hit you like a lightning bolt of clarity, drop the word lightning below. Every empire believes it can outsmart arithmetic, until the numbers turn against it. That moment always comes quietly at first: a mismatch, a shortfall, a curve that stops obeying the models. Then suddenly, everything that looks stable turns to glass. The same glow of innovation that once seduced the public becomes the backlight of surveillance. For CBDCs, that moment arrived the day the system began to use its power, openly. It always starts with an emergency: a financial panic, a cyber attack, a political protest. The first switches are justified. accounts frozen to prevent disinformation, wallets paused to protect citizens from fraud. Everyone nods, because at the start, the algorithm seemed to target only the guilty. But mathematics doesn't have ideology. It only has thresholds. And when you design a system that can monitor every transaction, sooner or later, it will monitor all of them. It's inevitable, like compound interest or gravity. The first real cracks appeared in the early 2020s experiments. Nigeria's e-Naira was hailed as a success until surveys showed 99% of the population simply didn't use it. People preferred cash or stablecoins or barter. Why? Because they sensed the hook. A digital coin that could be reversed at any moment isn't money, it's a coupon. The system tried to incentivize use with discounts and bonuses, but the math didn't lie. Without trust, adoption stagnated. In China, the e-CNY proved its efficiency. Too well. During COVID lockdowns, the government distributed aid directly through digital wallets. But when citizens in certain provinces protested restrictions, their health codes, the same ones tied to their wallets, suddenly turned red. Travel stopped. Funds froze. Officially, it was a glitch. In practice, it was a proof of concept. Programmable control executed flawlessly. That's when observers in the West began to panic, not publicly, but in reports, memos, think tanks, because the same architecture was being built everywhere. The Bank of England discussed conditional transfers. The ECB modeled spending limits. The US Treasury explored real-time taxation. The logic was mathematical. Once you can measure everything, optimization demands that you control it. But mathematics, once unleashed, doesn't care about politics. The more variables you track, the faster complexity explodes. Systems built on surveillance collapse under their own informational weight. The same way the Soviet Gosplan choked on its statistics, trying to plan millions of inputs and outputs, digital finance risks drowning in its own data. Each transaction adds noise. Each new control mechanism requires oversight, code, audits, updates. The very precision that promised stability becomes fragility. Then came the political breaking point. It doesn't matter which country acts first. History repeats the same rhythm. The moment a government flips the control switch too far, the black market blooms. Parallel economies emerge. Barter networks, private tokens, physical goods. In the 1790s, it was gold hidden under floorboards. In the 2020s, it's crypto, peer-to-peer wallets, cash stashes, offshore stablecoins. People don't fight systems with ideology. They fight with alternatives. Governments respond the only way they know, by tightening the code. More KYC, know your customer. More AML, anti-money laundering. More security. But every new restriction drives innovation underground. The cycle becomes self-consuming. The more they enforce transparency, the more opacity grows elsewhere. And then, inevitably, the math breaks the politics. Inflation in digital form looks different, but it behaves the same. When money can be created and distributed instantly by code, politicians can't resist using it. Stimulus payments multiply. Universal income pilots expand. The system floods itself with digits. But no algorithm can print trust. Prices climb, confidence falls, and people begin to convert their programmable currency into anything tangible. Food, real estate, crypto, even foreign goods. The digital cage begins to leak. History calls this phase overreach. In 1931, Britain's gold reserves collapsed because the promise of convertibility became impossible to maintain. In 1971, the United States defaulted on gold convertibility for the same reason. Too many dollars chasing too little metal. In the CBDC age, the same event happens invisibly. Too much code chasing too little credibility. Then comes exposure. Whistleblowers leak the truth. Algorithms aren't neutral. They're trained to reward conformity. A journalist finds evidence that transaction scores like social credit affect lending, travel, even insurance. A legislator demands transparency, only to discover that the independent central bank uses AI models supplied by private contractors, the same data giants that profit from surveillance. That's when the public finally understands. The system isn't failing because of corruption. It's failing because it's too efficient. Efficiency is the enemy of freedom. Every optimization that removes friction also removes discretion, the space where human judgment lives. The crash doesn't come as a bang. It comes as silence. People stop trusting the screens. They trade outside the network. They use barter apps, privacy coins, local credit. The digital dollar remains, but it circulates like a ghost currency, accepted only where compliance matters more than exchange. The system continues to exist, but its soul, the belief that numbers represent freedom, is gone. Mathematics broke politics, not through rebellion, but through exposure. Because when the ledger shows everything, you can't pretend anymore. The truth is binary. Either your money belongs to you or it belongs to the system. And once that realization spreads, no algorithm can contain it. If this part hit deeper than you expected, write, "I see the pattern." When a system collapses, it doesn't disappear, it mutates. The machinery of CBDCs didn't vanish after exposure. It rebranded, softened, disguised itself. The new slogans were smoother: digital inclusion, green finance, financial stability. But beneath the new paint, the old logic remained. Money was no longer value, it was permission. After the first wave of crises, defaults, protests, data leaks, central banks across the world agreed on a compromise. Hybrid models. Officially, citizens would hold their digital wallets through private banks or payment apps, giving the illusion of decentralization. In reality, the code still pointed upward to the central ledger. It was like the old monarchy restoring itself under a new constitution. Fewer crowns, same power. People adapted. You had to. Taxes were calculated automatically. Salaries came as tokenized credits. Welfare, pensions, and subsidies were distributed instantly, but with conditions. If your carbon score was too high, your travel allowance decreased. If your health data showed risk behavior, your insurance rate changed in real time. It wasn't punishment. It was policy automation. What began as a financial reform became a social operating system. Every transaction became a data point. Every data point a decision. The new buzzword was resilience. Governments promised the economy would never lock down again because now it could throttle itself automatically. Consumption could be slowed or accelerated with algorithmic levers. It was Keynesianism turned cybernetic. But the real shift wasn't economic, it was psychological. Generations that grew up on digital payments no longer questioned the system. They saw programmable money as natural. Why would you need cash, they'd say? It's unsafe. They didn't remember privacy as a right, only as a feature you could toggle, like dark mode. Still, resistance found new forms. Independent developers created privacy layers, wallets that broke transaction trails, encrypted peer-to-peer transfers, mimicked cash behavior. The authorities called them financial malware, but they spread anyway. People in Argentina, Turkey, and Eastern Europe began using hybrid solutions. Half official money for bills, shadow networks for everything else. A split economy, compliant on the surface, human underneath. Corporations, meanwhile, learned to weaponize the same tools. Big tech merged with central banking under the banner of public-private partnership. Your payment app, your social ID, your job portal, all linked. Algorithms scored your reliability across systems. One late payment could lower your trust index. One controversial post could freeze your loan approval. No policeman, no trial, just code. The empire no longer needed to silence you. It could simply delete your access. It wasn't dystopia. It was comfortable. Streets were cleaner, transfers instant, theft rare. You could travel, pay, and live seamlessly, as long as you didn't question the logic behind it. And that was the true genius of the system. Control that felt like convenience. People stopped rebelling because they no longer felt imprisoned. They felt integrated. But the cracks reappeared, slowly. Local currencies began emerging, backed by communities, energy, or even work hours. The oldest principle of all returned: trust between people. In some regions, city governments adopted open-source digital money, transparent and non-programmable. Ironically, they used blockchain, the very technology that CBDCs had once imitated, to restore freedom. At the global level, the digital dollar still ruled trade, but it wasn't trusted. It was tolerated. Nations held it not as faith, but as leverage. China built regional payment grids with its e-CNY. The BRICS alliance pushed for a digital settlement unit backed by commodities. The West responded with green bonds, programmable investments linked to carbon targets. The result wasn't stability, it was monetary Cold War. Every empire eventually exports its control. The British Empire exported debt. The American Empire exported credit. The digital empire exports algorithms. And as each spreads, inequality follows, not of wealth, but of access. The rich can move between systems, hedge with real assets. The poor are locked into compliance networks. In this world, poverty isn't the absence of money. It's the absence of permission to use it. And so the cycle completes itself. The same mathematics that exposed the system now governs it. The illusion of freedom returns, just rebranded as smart governance. The CBDC didn't die. It evolved into infrastructure. The more the code learns, the less the human decides. But if you look closely, the rebellion never stopped. It just changed form. Every encrypted wallet, every barter network, every handshake deal is a quiet act of defiance. Because as long as two people can exchange value without being watched, the system isn't absolute. The human spirit, inconvenient and unquantifiable, keeps rewriting the equations. In the end, the modern echo of the digital dollar isn't the technology, it's the mindset. Obedience disguised as modernization. And just like the empires before it, this one too believes it can regulate eternity. But eternity belongs to arithmetic, and arithmetic belongs to truth. If you're still listening in 2025, know this: the new empire doesn't wear crowns or flags, it wears code. And code, unlike kings, doesn't ask for loyalty, it just enforces it. If this vision hit close to home, write, "I still choose cash." Imagine the last moment when money was still yours, when a bill passed from one hand to another without leaving a trace, no ledger, no ping, no log. That moment wasn't about economics, it was about dignity. Because privacy isn't secrecy. It's the right to exist without being measured. Everyone thinks the danger of CBDCs is control, but that's only the surface. The real danger is the death of forgetting. In the analog world, time erases your past mistakes. In the digital world, the ledger never forgets. Every transaction, every donation, every wrong coffee bought in the wrong city, all of it lives forever. A permanent memory of your economic soul. Empires have always sought immortality through record keeping. Pharaohs carved taxes into stone. Monarchs kept ledgers of tribute. The modern empire engraves its control in code. And the code is perfect. It doesn't sleep. It doesn't question. It doesn't forgive. Yet there's an irony. The system that wanted total transparency ends up fearing the same light it emits. When money becomes surveillance, truth becomes contraband. People start whispering again, trading again, trusting again, outside the grid. History circles back. Every total system creates its own black market of freedom. So the real question isn't whether CBDCs will win. It's whether we will remember what money was for. Not to please governments, not to track citizens, but to measure value between free individuals. Gold, paper, digits, all of it worked only as long as it reflected trust, not submission. Arithmetic cannot be deceived, but humanity can be forgotten. That's the real collapse. When convenience becomes obedience and privacy becomes a crime, civilization loses its heartbeat. So guard that heartbeat. Use cash when you can. Support open systems. Speak about money not as consumers, but as citizens. Because the empire of code thrives on silence and collapses under awareness. If you've listened this far, remember this line. The opposite of freedom isn't control. It's comfort without choice. If this story changed how you see money, share it and comment the word awake. Because the future is being coded right now, and the only firewall left is consciousness.